Welcome to Decoding Retirement. Hi, I'm your host, Bob Powell, and today we're going to go behind the headlines with Ross Riskin. He's the Chief Learning Officer of the Investments and Wealth Institute. Ross, welcome.
Thanks for having me, Bob.
A pleasure. But before we get going into the topic that I want to discuss with you, I have a little disclaimer. I serve as a consultant to the Investments and Wealth Institute and work on the Retirement Management Journal and the Retirement Management Advisor, et cetera, et cetera. So I just wanted to give that disclaimer to our viewers and listeners so before we get going. So let's start here. You're a champion of the benefits of saving early for future education costs and making sure all members of the family are on the same page. Talk more about that.
Yeah. When it comes to saving for college or planning for that big expense that continues to grow, we need to know who's actually going to be involved in the funding process. And so I think a lot of the times we default to thinking, oh, it's just the parents there, and we forget about other people can play a role. Maybe they're grandparents. Maybe there's an aunt and uncle who they didn't have any kids, but they're well off and they want to contribute to their nieces and nephews' college education. And then the school itself later when we get into the process of applying to schools, are they going to qualify for need-based aid, merit-based aid? So, but understanding that early on helps us build a more accurate plan of how much do we actually need to save, right? So instead of just kind of running those calculations of saying, hey, a school costs $50,000 today or even more with some of these private schools, which we'll talk about, are we saving for the full 50, or is there a grandparent that says, hey, you know what, we'll contribute some? And when is that actually going to happen? And I think that I've encountered even more recently with clients is, the grandparents are coming out saying, hey, look, we're gonna help pay for $50,000 for Johnny's college education. Why? Well, we have the funds. And maybe that's what we helped contribute when you were in school 15, 20 years ago. However, sometimes what's missed is they don't fully capture that or quantify, well, when are you going to give the 50? Do you have the 50 right now that we can invest in like a 529 plan? Or are you saying that 20 years from now or 18 years from now when Johnny's in school, we're going to help contribute 50, which may buy books and a couple courses, maybe a meal plan. So it's understanding that up front. And we've even seen that as the case of those promises of what they can help with can change too. If their financial circumstances change, if maybe there's another grandkid or there's more grandchildren. So I actually encountered that recently with a client where it was that exact thing. There were two grandkids. The grandparents said, hey, we're going to allocate $50,000 for each. And then guess what? One of the other sons had another child, and they came back and said, oh, you know what? We're actually not going to be able to do 50,000. How about we'll do 30,000 for each, right? So those factors, it's important to just be aware of, hey, what's being promised and kind of getting that in paper and getting a plan in place to know that, well, hey, if they're not going to come through with that, or they're not going to give it to us now, or not going to invest it now for our kids, we need to make sure that we're saving enough because we're going to have to possibly cover more than we thought we would.
Yeah. So when you talk about getting everyone on the same page, it sounds like it can be a bit of a difficult conversation to say, hey, Mom, Dad, can you afford to help us pay for our son, daughter's college? Or, hey, Aunt Mary, we're thinking about funding college. Can you help? Is that,
yeah, no,
conversation?
It really is. I think it depends on everybody's education funding philosophy and really college funding philosophy too. I think it's going to go back to, well, what was the process or what was the history of even each client, right? So I meet with a lot of people where, hey, let's say there's two spouses and one went the route of going to public school. They did great. They never went to private school and state university. And the other one went the other way, right? K through 12 private, went to maybe a small liberal arts college. And so they have different philosophies around education, around funding. And likely that's rooted in maybe what their own experiences with their own parents were, right? So maybe you have one set of grandparents where it is more awkward to talk about it because they're thinking, well, you just went to public school. Why would we save for any of that? You'll just go to the state school or we'll just help contribute, or can't you pay for it like we did, even though it's very different, and that just does not work anymore. And then you get somebody else that says, hey, you know what? Education is very important to us. We want that to be part of our legacy, like for you, of what we pass on to your kids, not only the knowledge and the stories and lessons, but we'd love to be able to contribute of helping out with tuition, maybe now for private school or later on for college. But it's everyone's planning decisions are different, right, of what they're going through. I think just given this past year of, the the potential sunset of Tax Cuts and Jobs Act really put into focus this idea of gifting. Hey, making gifts, especially for higher income, high net worth families to get it out of their estate. A popular vehicle was, hey, put it into a 529 plan where you can make larger gifts, use up, make a 5-year election without touching any of the exemption to do that. So that actually brought it to the forefront of involving other family members, maybe who are more affluent, that now that's part of their overall strategy. It's good from a tax planning perspective, and they get to do something good for their family.
So you mentioned one vehicle for which people can use to fund college education. There are multiple vehicles.
Yeah.
Talk more about them and the advantages, pros and cons of using them.
Yeah, there's a lot of different ones. 529 plans are obviously, tend to be the go-to, but they're still underutilized. I think there's also that misconception, or at least in the advisor community, of, well, everyone knows what a 529 plan is, but that's really not the case. We love those plans, and really, when selecting a vehicle, we like to look at 4 different criteria. Really like to look at operational flexibility to begin with, meaning, how do we open up an account? How does money come into the account? How do you get money out of the account? Who do you name as an owner? Can you change the owner? Can you change the beneficiary? Then we like to look at investment flexibility. How much money can you put in the account? What can you invest in once you fund the account? What are there limitations? How many times you can change those investment allocations? So 529 plans are more limited in that, where you can put a lot of money into those accounts, and they vary state by state, but you can only make 2 investment changes per year. You have a limited selection of investment options. Most people will go into some sort of target enrollment portfolio, very similar to like a target date retirement fund, right? That kind of has a glide path that changes the allocation over time, gradually becomes more conservative. And then the third piece is tax efficiency. So we're looking to say, well, do I actually get any tax benefits by putting money in, making some contributions? Do I have to pay taxes while the account continues to grow, or is that growth deferred? And what about when I take the money out? Do I have to pay taxes on those earnings? Another benefit for a 529 plan, or even a covered L education savings account. And then finally, the financial aid efficiency piece, right? Of, hey, if I own this now, is it going to be assessed as an asset for financial aid purposes? Is it not going to be assessed? But if I take money out, is it going to be assessed as income, which is much more detrimental from a financial aid planning perspective? And who owns it? Is it the parent owning it? Is it the student owning it? Is it a grandparent owning it? Is it somebody else who's not in the family? And how does that actually interact and play with it? So we like 529 plans because they check a lot of those boxes. But if you're somebody that, hey, you want to invest beyond just the limited options that are in there, you can do that in a covered L account. Right, you can do that in a taxable brokerage account. You could do that in a custodial, an UTMA or an UGMA account, but you're maybe going to sacrifice. Well, you're not going to get the tax efficiency in the brokerage account. The covered L is great, but you can only put in $2,000 per year, and you can't put any of that in if you're over income limitations. So maybe you're utilizing other family members to actually contribute to that account who are under the income thresholds. So it really is this. This puzzle that you're trying to put together of what works. But what we are fans of, and I'm a big fan of, is a multi-savings vehicle approach, right? I'm not an all or nothing. I'm not put everything into 529 or put everything into a brokerage account or use some other product or solution. You want to have flexibility with where things are going from an education standpoint, of maybe what you think you want to plan for higher education. It may change. It may be different there, and you want to use those funds earlier. You want to have flexibility in what you can use to help you reach those goals, as maybe the mileposts move around a little bit on some of those goals.
Yeah. What about Roth IRA accounts? Would you put those into the mix of savings vehicles?
Roths are tough. I mean, they're good in the sense that, hey, any money in a Roth or any retirement account like that doesn't hurt you from like a financial aid perspective. You have some benefits of being able to tap that money, but we're usually not advising people to tap that money to pay for college. And as we saw with, Secure Act 2.0, you now have this ability to roll excess funds you may have in a 529 plan into a Roth IRA. So just another reason why it's good to use multiple vehicles. And we're kind of seeing that question answered around why would you use a 529 plan? I still get those questions of, well, my son or daughter is really smart. They're going to get, what if they get a scholarship and you don't need the money? You have so many things you could do with the account, right? Like you could change the beneficiary to maybe another son or daughter. You can keep the money in there and do nothing. And then what you've done is you've just jump-started planning for your grandkids or great-grandkids' education. It's one of the best legacy planning vehicles because you're not required to ever take money out like you would with, a tax-deferred retirement account, like you would if you inherited even a Roth IRA, with a 10-year rule. So you can keep that moving on and growing tax-deferred to benefit education costs for future generations. So
Yeah.
a lot of different options.
So when I think about couples, families saving for college, oftentimes they're faced with the dilemma of multiple goals, limited resources, saving for retirement. At the same time, they're saving for college. How do
That's
they?
not a challenge at all, Bob. What are you talking about? That's it. We all know what that is. No, it is a challenge. It's a real one. And it's something where, if you ask the advisor community of like, well, what do you prioritize? Right? You have all these goals. So how are you prioritizing that? And everybody will say in agreement, retirement takes priority over saving for college, right? You have many options to pay for college, as I just alluded to, even other people kind of
We haven't even
contributing.
talked about loans,
right?
yet.
Exactly. So you have that you don't really have with retirement. But I think what's important is how you frame that conversation, get people to think about it. So I think you could think about it quantitatively, and that's saying, hey, look, if you have these two goals, and let's say you want to save, a couple $100,000 to pay for college, and you need a couple $1 million to reach your retirement goal, but you only have $1,500 or $2,000 a month to allocate towards that. What do you do? So you can actually frame that out to say, well, look, if we want to meet the college goal, that means you're going to actually have to work a couple more years because you're not going to hit that savings mark for retirement. Or if you want to meet the retirement goal, guess what? We're only going to fund half of, what we wanted in the 529 in the brokerage account. So we're going to have to maybe adjust our expectations of what we can afford, or maybe the student has to take on some of that burden. But the other way to do it is I like to do it more qualitatively as well. So not only looking at saying, well, where's the family, are they on track for retirement to begin with? But then looking at the student and saying, who are we dealing with here? Is it somebody are they really good academically in school, whether it's grades or test scores? Are they motivated? Do they actually want to go to school? Do they have any idea what they want to study or major in? And that kind of helps you in this matrix of determining who does the primary funding responsibility lie? Is it with the parent or is it with the student? And what's the main factor? Are we looking for a school that's best fit for the student? Are we looking at something that's a financial fit that takes priority? So having those conversations is good because you want somebody kind of the top right of the quadrant, right? Where you're on track for retirement. You got a student who's really good in school. They're, motivated, where you have a lot of options, right? Like you can spend and not hurt your chances of reaching your retirement goal. The student maybe takes on some debt if they want to, but then if you're bottom left quadrant where you're not on track and you're dealing with a student who doesn't do well in school, they don't even know why they're going to school, they're not interested in college, you're in this you can't borrow to pay for retirement quadrant, and the funding responsibility really is on the student because the parent just can't afford it. Plus, it's not a great investment of their time either because the student is maybe not ready for that just yet. So they need to actually bear that responsibility a little bit more.
Yeah. Ross, we have to take a short break, but when we come back, we'll talk more about the Trump administration's impact on higher education. But first, we're going to answer a reader question in a segment that we call Ask Bob. And the reader's question goes like this: does it matter whether I invest in a in-state 529 plan or not? And I would say that when deciding whether to invest in-state or not, there are several important factors to consider, and I'm going to lean on Ross to help me answer this question. Ross, what
should have been said? Ask Ross. No, it's a great question. I think when we come down to it, it's okay. Great. I want to do a 529 plan and put money in there. Now, what do I pick? Is it my in-state plan or is it an out-of-state plan? So some of the more important factors there are, number one, does your state actually provide a state income tax deduction? If we assume it does, it's then saying, well, what is your effective state income tax rate? And then what's the amount of the contribution you're looking to make, and what is your time horizon? And those matter for a couple of reasons, right? The effective state income tax rate matters because that's going to tell you, well, what's the value of actually putting money into the account? But it also needs to match up with how much you're looking to contribute. So if you're looking to contribute a lot of money, maybe you're a late stage funder where, hey, we're going to put $15,000 or $20,000 in, but you live in a state where you only get a $4,000 deduction. Well, you're getting some of the benefit, but not all of the benefit there. But if your time horizon is so short, the value of the state income tax deduction can actually outweigh any benefits of tax deferred growth in the account. You just do not have time on your side to be invested in the portfolio that would need to generate that type of return. If you're only a couple years away, you're going to be in a portfolio that has higher fixed income allocation, higher cash allocation. You're just not going to be relying on investment performance in there. So you would lean on your state plan. Those are some important things to keep in mind.
Welcome back to Decoding Retirement. I'm talking with Ross Riskin. He's the Chief Learning Officer of the Investments in Wealth Institute. And Ross, I want to play a clip for you. It's Mark Rowan. He was speaking at the Yahoo Finance Invest Conference. And he was talking about the use and value of private assets inside retirement accounts. And we'll play the clip and we'll get your reaction.
Every place else in the world where the addition of private assets, the addition of other types of assets to retirement plans has been tried, it has resulted in better outcomes. And not slightly better outcomes, 40 and 50% better outcomes, Australia being a case in point. I think one of the upsides for our industry is a revisiting of this whole notion of public being safe and private being risky, potentially including into retirement solutions, which is what our country needs.
All right, Ross, so your reaction?
Yeah, I mean, there definitely is a demand for investing outside of public markets. Like we're seeing that even at the advisor space. I mean, at the Investments and Wealth Institute, this year alone, we've put together several focus on series where the focus is alternative investments, private markets, private assets from private real estate, private equity, private credit. To just diversify the risk in these portfolios, we need to build out and expand the portfolio beyond just equities and stocks or equities and fixed income in the public market. We need these private assets to try to, seek diversification and just maximize after-tax returns.
Yeah. And I think in a world where we're seeing fewer publicly traded stocks, lower expected rates of return on those stocks, the increased use of these assets inside both public and private pension plans, it's not like we're asking investors to do something extraordinary. We're giving them an opportunity perhaps to improve their risk-adjusted performance, perhaps.
Exactly. No, that's where the trend is going, and I think rightly so.
Yeah.
It's that diversification, it's multiple options in there, and just kind of rethinking the whole portfolio construction matrix and equation and question there to really build out truly efficient portfolios.
Yeah. I think for me, the biggest challenge is the education one that you just sort of referenced as you're thinking about rolling out these courses for advisors. When I've talked to experts on the matter, they've talked about the illiquidity premium. And I'm sure that's going to be a term that doesn't roll off the tongue of the average investor when they think about investing, like, what the heck's a illiquidity premium?
Yeah, no, for sure. And I think but understanding your time horizon, right? Of, hey, if you don't need this money or you don't need these assets or these funds for a certain amount of time, that really shouldn't be a big issue for you. That shouldn't be the big barrier that it has been in the past. It's getting people comfortable and aware of that as well, right? Yeah. It's not the exact same, but it's a similar thing of when, hey, interest rates were high, so you see people rushing into CDs, right, and cash, but at the same time, the markets are doing well as well. And if you didn't need the money there, you kind of placed some extra value on the liquidity side of things when you're sacrificing returns for that.
And I think that was Mark's point, was if you're saving and investing for a 30, 40, 50-year time horizon, the illiquidity shouldn't be a factor. In fact, the liquidity is not even right?
Correct.
It's like overvalued. So,
for sure.
All right. So I promised that we would talk about the Trump administration. We're a couple days past the election, and goodness knows what's going to happen with student loans, repayment plans, federal funding of public and private schools for research, et cetera, and what's a parent to do who's thinking about all this?
I think a couple of things that are going to be safe and a couple of things are maybe not going to be safe. I think what's going to be safe are some of the provisions from Tax Cuts and Jobs Act, right? We're going to see a lot of those try to get extended and maybe some new things that come in. But one of the big things that came out of that was the provision to use 529 plan funds for K through 12 tuition, $10,000 per year. I think what's maybe in some trouble are the new SAVE income-driven repayment plan. Some of these other things around loan forgiveness with these plans, I would be questioning. I don't think it's going to be this hard sweep of eliminate all of that, but I think what's now back on the table that also expires at the end of 2025 is the taxation of loan forgiveness under those income-driven repayment plans. That maybe doesn't get extended. So now we have to be factoring and thinking about that. It's funny, whenever we would think about that from a planning perspective, we were always being more conservative in that the way things were going, it looked like, hey, no one's going to be paying income taxes on $600,000 of loan forgiveness because most people aren't saving for the tax, a lump sum tax bill. So you'd almost factor it into your plan of like, let's just assume it's going to be. It would be the same thing as if you were doing a retirement plan for somebody young today. You'd say, you know what? Let's not factor in Social Security benefits, or we'll factor in a limited amount. I think two that are going to be safe, though, is the income-based repayment, IBR, just based on when that was passed, I think years ago. I think that was even under the Bush administration that was passed, and public service loan forgiveness. So I don't think that's going anywhere. Like, it would be tough to really overturn that. You have so many people that have already worked through that process, and we're really disadvantaged by the lack of clarity in the rules of the payment counts, issues with loan servicers and the processing piece. I think you're going to see limited options for newer borrowers going forward, but I don't think they're going to totally kill those repayment plans or totally kill the forgiveness element. It just may not be as beneficial as it seemed to be during the pandemic where, hey, didn't have to make any payments, no interest accruing, yet you're getting payment counts as if you're working towards loan forgiveness. And hey, if you made payments on those, you could actually get a refund of all your payments back. So I don't think we're going to see things like that moving forward. But I think the other thing that's important to be aware of is maybe on some of the immigration policies as regards to international students coming to the U.S. I mean, a lot of schools are budgeting for those students, for those international populations. I think it was a school where I think they had budgeted for 1,300 international students paying full ride, and only 300 ended up coming.
Yeah.
So you're going to see maybe some pressures back on the schools there of they're not going to meet their budget. So what does that mean? Is that going to accelerate closures? Is that going to force layoffs? Does that force them to raise costs in other areas and places? So a lot of opportunities there. I would say you don't have to run out and pay off all your student loans now, or it's still kind of a waiting game to see.
What about federal loans? Do you see subsidized and unsubsidized loan rates maybe going up or staying the same? Or
yeah, that's a good. I haven't looked too much into that, so I think we have to see on that. It's not really a big amount to begin with. I think what a lot of people don't realize is that when you hear, subsidized loans, that's the government paying the interest on the loan while you're enrolled in school. A lot of people assume, that must be for lower income people. But the reality is you qualify for a subsidized loan if you demonstrate financial need at a school. So the fact that schools are increasing their prices and we're in this race to $100,000 a year tuition, you could have families that make quite a good amount of money actually qualify for for subsidized federal loans. So we'll see where it actually goes. With those adjustments.
I hate to do this. We have like a minute left, Ross, and I want you to sort of tell our folks the importance of filling out the student aid forms called FAFSA.
Oh, yes.
And whether they think they qualify or not for aid, it's important for everyone to fill it out.
Absolutely. It's always important to fill it out. A couple of main important reasons. So number one, if you want to even have the ability to borrow those federal loans, as I mentioned, to possibly qualify for forgiveness, you need to fill it out. If your kids want to be able to qualify for work study, you need to fill it out. There are also some schools that will only award merit-based scholarships if you fill that application out, right? Regardless of if you demonstrate need or not, it's just part of the process. So it's always good to have those options, fill it out. And like I just alluded to before, you're seeing that's the silver lining here of schools increasing their prices is that you're going to have more families that thought they made too much money before may actually be qualifying for need-based aid at schools that cost $85,000, $90,000, $100,000 per year.
Russ, this went by in the blink of an eye. I want to thank you for sharing your knowledge and wisdom with our viewers and listeners. Thank you.
It's great being here, Bob. Thank you.
All right. Well, now it's time for our segment that we call Ask Bob, where we answer a reader question. And the reader's question goes like this. I'm thinking about contributing to a spousal IRA. What do I need to know? And the answer is, if you file a joint return, you may be able to contribute to an IRA even if you didn't have taxable compensation, as long as your spouse did. Each spouse can make a contribution up to the current limit. However, the total of your combined contributions can't be more than the taxable compensation reported on your joint return. Read IRS Publication 590A for more about that. If you've got questions about retirement, I'm here to help. Email me at askbob@yahoofinance.com, and we'll do our best to answer your questions in a future episode. So that's it for this week's episode of Decoding Retirement. We hope we provided you with some actionable advice to help you plan for or live in retirement. And don't forget, for the latest retirement news and expert analysis, visit yahoofinance.com.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.